Hi, Peter Rose, Longwood Currency Trading. Today I'd like to chat a little bit about what I call taking an anticipatory trade. In other words, taking a trade before you should take it. This is more of a psychological thing, right, than it is technical. It has to do with what they call FOMO, fear of missing out. You look at a chart situation and you say, well, if this happens and that happens, then this will be a good trade, and the profit target will be great, and I've got a good reward to risk ratio, and all that other sort of stuff. And so, though the mechanical aspects of the trade setup indicate that there's a trade there, our emotional structure, our fear of missing out, our greed to make the trade causes us to anticipate, well, this looks pretty good. It looks like it'll go another 3 or 4 pips, and then it's going to cross my boundary line, or it's going to fulfill the specifics of my analysis, or whatever it is that you're doing to justify in your mind the conditions are good for taking the trade if certain things happen, and you jump the gun on it. You say, well, look, it's been going in that direction. I think it's got enough juice. It's going to cross that over. And you take the trade. That's an anticipatory trade. It doesn't work out. It can be as deadly as averaging into a losing position to reduce your risk. It could be that severe, because what happens is that because you were so eager to take the trade, you really wanted to take that trade, that means that when the trade goes off and starts to turn against you, you are less likely from an emotional standpoint to give it up, because then you have to admit that you're really, 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 really wrong. Jesse Livermore had a great quote. He said, "To anticipate the market is to gamble. To be patient and react only when the market gives the signal is to speculate." You got to wait for that signal. But waiting for the signal, again, is not so much the mechanics or the plumbing or the technical aspect of that point, but having the emotional stability not to act. Jesse Livermore also calls that sitting on his hands. You simply can't anticipate that something will happen. You have to wait until it does happen. In physics and mathematics, we can anticipate stuff through probability analysis. The whole Brownian theory of motion was developed around this statistical likelihood that some particle in a group of particles will behave like the group, and thus having that massive momentum will continue moving in that direction. And you wouldn't expect that if you fired a cannonball out of a cannon that the ball was all of a sudden going to make a U-turn and go straight up. It's in a parabolic arc. It's calculable from the time it leaves the muzzle of the thing. You can pinpoint the drop of that ball within inches. But you can't do that in trading. Indicators that you have and use, and again, I'm not a proponent of indicators per se. I'm a proponent of using certain indicators to do what they're supposed to do, which is to indicate that certain conditions have arrived, so that you have to wait until the indicator is validated in order to take the trade. And you got to remember that all the indicators are based on what happened in the past. It's an average over the past. If you're looking for a fast moving average to cross a slow moving average, let's say you're looking at an 8 period to cross 21, okay? Well, if you're in a 5-minute period, that's averaged back 8 5-minute periods is 40 minutes. So what you're seeing right now in that 8-period moving average is what happened 20 periods ago. That's where the average is. And in fact, everybody out there that's plotting moving averages on their charts is incorrect in the way in the way, from a mathematical standpoint, in the way that they're positioning that moving average. Regardless of that, I'm not going to go into that. That's not the thrust of the video here. The thrust is to be aware that simply because you have indications that a certain event could occur, number one, you can't anticipate that that's going to happen by taking the trade then. That's an anticipatory trade. And number two, you can't even take the trade once the indicator has been reached, or the theoretical position that you've calculated in your mind has been reached, because of the fact that the indicator itself, no matter what the indicator it is, I use moving averages all the time because it's easy to understand that they are what happened in the past. So you have to wait until, like, for example, if you're looking at a support zone, all right, that support zone is, you're looking at that being broken. Well, that support zone was created by touches 3 times in the past, and they don't have anything to do with the time frame you're on. Those touch points could be done over literally days, or maybe if you're on a 5-minute chart, maybe it's 15 minutes or 2-hour things. You can't draw a support zone on a 5-minute chart and trade the 5-minute chart. That doesn't make any sense. And besides, the spread between the two is so small, couldn't take advantage of it anyway. So again, you're relying on lagging indicators. If it's an 8 cross 21, for example, that fast moving average is 20 periods back. That's where the real meat of the average is happening. So you can't even consider that if you take a trade when your indicator is all flagged, let's go for it. You can't even do that because that's still an anticipatory trade. You be very, very careful about this stuff and who you listen to as to who's interpreting how you're supposed to be trading, using indicators or patterns or anything else that's out there. Because what happens is that by focusing on those indicators, you have even more of a feeling of fear of missing out, and you're more likely, if you don't have real control over your emotional structure, to do that anticipatory trade. So just be aware of that. I wanted to bring that out as it's something that was mentioned to me not long ago by someone. We were talking about trading and some of the problems that they were having. And you know, they were a long-term trader. I'm a speculator. This person was a little bit more long-term in their approach. But they're still faced with the same thing. In fact, I think in a long-term trading situation, it's that fear of missing out, that anticipatory trade is highly more likely to affect you than it is if I'm looking at a 5-minute chart or a 1-minute chart and I'm going, well, I can wait another 30 or 40 seconds to make sure this thing is really going to lock down as to where I want it to go. Well, what are you going to do if you're on a daily chart? Daily chart with an ATR of 120 pips, and your support zone could be 10 pips wide, and so you're going to have to wait not only for it to get 5 or 8 pips on the other side of that support zone, but you're going to have to let the mean of the average or whatever it is where that line is drawn, have that catch up so that you're sure that that's there. So that means you're going to have to wait maybe 15 or 20 pips. Well, what happens when you wait 15 or 20 pips? Most of the time in the Forex market, when those support and resistance areas are broken, there's a retraction to that level, because breaking through that level is absorbing orders, standing orders that are currently there. Then people get in and move the wrong way with that, and as they do so, it brings the price back up because those orders are being fulfilled, and it brings the price back up. Because most people are saying, well, it's going to touch the support and then it's going to go up. So it goes down through the thing, and they put their stops there and they enter going on the short side, and boom, the fact that it keeps going for a distance is great until it turns around and other people are getting whacked out because they put their buy orders at the bounce. So now they're selling to get out. It's just, you just have to wait. You can't have an opinion, and that's one of my rules. I cover this in one of my blog posts on longwoodcurrencytrading.com. If you want to go there and check out my blogs, that's one of the issues that I deal with is that particular scenario. So a couple of things on anticipatory trades. Don't do it. Don't think that the current movement is going to continue, because it may not. And number two, if you're basing your decisions on a confluence of indicators, you're going to have to give it more time than just when the indicators are recognized by the price action. Hopefully that helps you. If you have any questions or whatever, look that up on Google, or if you feel desperate to talk to me, you can send me an email. But again, I'm not in a training mode. But you really need to get a lock on this thing called anticipatory trade. And I want to leave you this quote from Livermore again. To anticipate the market is to gamble. To be patient and react only when the market gives the signal is to speculate. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.